City's new partners, EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey everybody, this is the Tax Lady, and this is our half hour to talk taxes. And not like everybody isn't talking taxes, but we're going to talk taxes so you can understand them. If you have any questions, you can join us here in studio at 803-0930, 803-0930, star 930 on your cell phone. And Stevie, I know you know the toll-free number off the top of your head.
Absolutely, 1-800-616-9236.
Okay, so obviously Steve Jacobson is there with us, our Assistant District Manager, Chris Fabian, our District Manager, and his lovely wife, Tiffany Fabian.
Hello,
and so
Esther.
We're all in studio.
Yes, happy Saturday to you.
Yeah, and Thanksgiving's coming up. Can you believe it?
No, I can't.
I guess we should be thankful that the Bills won a game.
Yes. I mean, they still have a playoff chance, right?
A slim one, but they still have one.
Yeah, and you know what, Esther? I wanted to say Steve Jacobson has been working really hard, and he made some great changes to our website and also to our Facebook. So if anybody hasn't Facebook friended us, go ahead and you'll get tax tips and a whole lot of bonus things.
I want to tell you, it's a good thing to have us as a Facebook friend, because as things happen, you listen all week long. Last week we talked about the fiscal cliff. All week long, people have been saying pretty much what we said 1 week ahead of time. So, that's one thing we try to do on Ask the Tax Lady, is get you up to speed before everybody else is up to speed. And the other thing is, we're local. You can call us. You can stop in. We don't charge you to stop in. We love you. And so, our website is egtax.com, and Stevie is our web guru.
And
He's done some wonderful things with the website. So look at egtax.com. There's all kinds of tax changes. I know he's got stuff on the fiscal cliff. I know everybody's sick of the fiscal cliff.
We're all ready to jump off of the fiscal cliff.
We're going to jump off the cliff.
Yeah, well,
all right, but we're going to talk today. And again, 803-0930, 803-0930, star 930 on a cell phone. And Stevie knows that toll-free number.
1-800-616-9236.
Like if you're in Rochester or Arizona or Florida, give us a call. Or Canada. All right, so look, everybody's talking about the sale of capital assets for 2013. The capital gains rate is going to go up. So it only makes sense, you got a month and a half, sell your capital gains that have appreciated, if they still are appreciated after the 500-point dumper here, the 800-point dumper this last week. But if you're holding gainers, you might want to look at selling those gainers before 2013. And I got an example. Let's say that you're a retired person on a $25,000 pension, maybe dividends of $1,000, which would presently be tax-free. Social Security of $30,000, only $4,500 of it would be taxable. Your adjusted gross income in 2012 would be $30,500. After your standard deduction, personal exemptions, your actual tax bill would be $823, because you'd pay 0% on capital gains and dividends. Now, if you wait till next year to sell those same stocks, you'd have a $15,000 gain from the stock, which is the same as this year, but you will pay taxes of an additional $2,000. You'll pay taxes of $2,139. So I mean, you'll pay an additional tax.
Yeah, one of my clients.
$39, and so that's a gigantic increase.
Yep.
So think about selling those stocks now.
One of my clients, Joanne, she's actually one of Mike and Glenn Lomas's clients too. She's a mutual client, and she called me yesterday and she said, Tiff, before the end of the year, I'm going to sell a whole mess of my gainers, and do you recommend me doing that? And Chris walked by, and we both gave her the thumbs up and said, go for it.
And the other thing too that you got to consider too, since 2008, people still have some losses that they're carrying over, so they might even have some remaining losers to offset those gainers that are coming back in too.
the whole thing is you can stop in at EG Tax. We're going to charge you nothing to go. If you're a client or not a client, we will help you to plan. You know, the whole thing of tax planning kind of went by the boards with the Bush tax cuts because tax rates were so low. Now we're looking at one of the great things about knowing who's the president is to know what's going to happen. And so we know that tax rates are going up. And unless you're fond of paying taxes, which that may be where you're at, but if you're like
Warren Buffett.
most people and you don't want to pay what you don't have to pay, you have a month and a half to dump your gainers. And so you might say, well, I don't want to sell my stock because I like that stock. What can they do, you guys?
Well, they can sell it now, pay tax at the gain now on the lower rate, and then buy back their stock. So they still have the stock. They have a basis now of what they're selling it for, and they're paying less tax.
That's exactly right. So the whole thing is you can step up your cost basis by getting rid of those gainers, paying it at a lower rate, and then buy them back, and then you have a new stepped-up basis, and then what case sera, whatever happens in the future happens.
That's
right?
exactly right.
Yep.
That's exactly right.
And then the other thing is people that have adjusted gross income over $200,000, $250,000, married joint, starting in 2013, are going to pay an additional 3.8% on non-earned income. So that means your interest and dividends are going to cost you an extra 3.8%. So
Yikes.
those are all things that you need to consider. And so obviously looking at contributing to your pension plan is really, really important starting in 2013 because you want to reduce your adjusted gross income.
Yep.
Yep.
Absolutely.
You know, and it's not, you know, we're talking stocks. I mean, if you have a house that's your mom gave you and now she passed away, but she put your name on it before she died, you may want to sell it now before next year because that's capital gains too. I mean, there's a lot of things that fall into this range.
And actually, we can help you. Like, for instance, let's say you have somebody that wants to buy the house before the end of the year and they aren't able to get the mortgage. We'll help you to set up an installment sale so you can sell it now, get paid the next year, and that'll still come into the 2012 previously taxed capital gains rate, right?
Absolutely. And, you know, it's funny because we were talking about capital gains in class today and how big of a deal it is. And the one thing we were talking about is also, you know, those people that get life use of the house where they gift the house over versus estates as well. And so, you know, if you're one of those people that were put on the deed before mom and dad died and you've been kind of sitting on it, you know, and let's say you don't know exactly what mom and dad bought the house for and you don't know what their basis is, now would be the time to sell it just so that you can get rid of it and you know, pay the lesser tax on it at the end of the day.
You know, and Steve, that's a really good conversation. I mean, really good point. But, you know, a good conversation to have with mom and dad if they gifted you the house is what do they put into the house? What kind of improvements do they make? And what was the cost of all those improvements? Because those are important questions to ask them, because if they should leave us and you don't know what those answers are, then that's really a problem.
You're absolutely right, because I mean, we all know how many clients have come in where they said, yeah, mom and dad passed away, but you know, they had life use of the house, they gifted it to me, you know, and then we say to them, okay, how much did mom buy it for? How much did they put into it over the years? How much this and that? And you'd be surprised with how many people can't tell us because they just don't know.
And of course, if you can't prove it, then it doesn't go to basis, right?
That's right.
And then if one of the parents passed away, they get half stepped up basis for one portion of the house, right?
Yep.
That's true, because, you know, and all of that is very complicated. All right, I'm Esther Gulius, the tax lady, 803-0930, 803-0930, star 930 on a cell phone. We'd love to hear what you have to say, whether you've gotten love letters from the IRS, haven't paid your taxes, or maybe you haven't even filed your returns. We can help you with that. 803-0930, star 930 on a cell phone. And then what are some of the other things people ought to do before the end of the year?
Well, for the not so young, you know, there's the required minimum distributions, the RMDs.
So explain that, Chris.
Well, if you are 70 and a half you have to take out of your pension or your IRA now, and it's not a percentage, it's a divisor rate that you have to take out based upon last year's ending balance. And if you don't, the government penalizes you 50% of what it is. So say you're supposed to take out $7,000, and oops, I forgot, I didn't know about it. Well, there's a $3,500 penalty on your tax return.
I mean, it's not $3,500
Added as
income. It's a $3,500 bill you pay, right?
Correct. It's huge.
So you want to make sure you check with all of your financial institutions if you're over age 70 and a half to make sure that you take out the required minimum distribution. Otherwise, once you're age 70 and a half, or otherwise you're going to pay a 50% penalty on what you did not take out.
Yep, and I know I had like at least three people this week that came in and go, what do I do? I'm now 70 and a half. And we went over the planning, whether to wait till next year before April 1st to take it, and then take the other one after that, or take it this year.
Explain that loophole, will you?
Sure. The year you turn 70 and a half, the government says, well, we know you're 70 and a half, but we're going to give you this one-time escape, basically, postponement, if you will. They say, you don't have to take it by the end of that year, so we'll say 2012. You have up to April 1st, 2013, to take your first distribution. And then at the end of 2013, you would have to take out your normal 2013 distribution.
So basically, you take out the RMD twice in the next year after reaching age 70 and a half, right, Chris?
Right. And it all comes down to tax planning and looking at your income and seeing what's better for you, to take it this year or to take a double hit next year. But that's only one time you can do that, and that's the year you turn 70 and a half.
Right. So, and if you're 70 and a half and you're confused and you don't know what to do, or anybody that's listening and you just want to do tax planning is going to become very critical now with tax rates going up. And of course, we talked last year about the closing of the Bush tax cuts. If those things go away, the average person is going to find out that they're paying a lot more taxes too. So you want to make sure that you do tax planning, and EG Tax will help you at no charge. Our website is egtax.com. Our phone number at our corporate office is 632-7886, and we're very happy to help you, right?
Yep, absolutely. And then another thing
let's go to the phones, and I think we got Tony from Franklinville on the phone. Hi, Tony. How can we help you?
Yes, thanks for taking my call. My mom is in a little bit of a dilemma. She has an investment and she's 73 years old. She went into the donut hole last year, and she tried to apply for Epic, I believe it is. And sure. she went over by a few $100s. And my thought is there a way of circumnavigating that? Say, for instance, if she doesn't file tax, but if she did, could she make a one-time contribution, and she does every week to her church, but could she make a lump sum payment to her church so that it would reduce that amount of money?
No, see, unfortunately, the donut hole is based upon your income. So if it's income, there's really nothing she can do except, like, for instance, if she has interest and dividends, she can reduce the amount of interest and dividends that she has by gifting some of this money to you so that she gets less interest and dividends. And let's face it, they're not paying you much right now. But her donut hole is based upon her income, not her income after her deductions. So that's not going to help her. So I think the best thing to do is maybe stop in or call us, and we can work with your mom and you as to what she can do to reduce her overall income.
Yeah, and I know, Tony, the EPIC program is higher threshold to reach than STAR or anything like that. So it's a higher thing to accomplish than in STAR. So, the amount of money that you can make is much less in that type of thing. So, yeah, stop by and call us, and we'll work through the numbers.
Yeah, but sometimes, as we get older, the best thing to do is to gift to our children, and we can gift up to, right now, through the end of the year, up to $1 million to our heirs, and that would be completely tax-free to the heirs. It's not deductible to us, but then the great thing is it reduces the amount of income that you have. So she might have a large amount of money in savings account, and she doesn't have to worry about that. So that's something she might want to look at. So you can call us 632-7886, egtax.com. We're very happy to help you. Okay?
I'm going to do that and bring her with me. Thank you.
All right, thank you. All right, and who's our next victim here? We got Jay in North Tonawanda.
Hi, Vic. I have an opportunity to listen to you guys all the time. I really like the show, but this is the first opportunity I've had to call because I was actually getting a little debate with a friend of mine this week over statute of limitations for owing taxes. And let me give you this scenario, and then you can tell me what goes on. He is in a situation where he collects a disability, and he's been in that situation for close to 10 years now, and he's owed approximately, I believe he said, I know it's more than $5,000, it hovers around $10,000 in debt. Now, I'd never heard that there was any statute of limitations ever. I thought that once you owed a federal tax debt, that was it. You die with it unless you pay it. He hasn't made any payments on it in, I believe they said, like over 6 years because he's in what they call a non-collectible status. Mm-hmm. So I guess to cut to the chase after giving that scenario, is there such thing as a statute of limitations where they will no longer collect it, and how long is that?
That's absolutely true.
Yep.
You guys want to tell us about
Jay, you win the argument. There is no statute of limitations if you owe the money.
Go
on. But he can remain in the uncollectible status.
But after 10 years, though,
right,
they could remove that because it only goes for 10 years. So yeah, after 10 years, if he's non-collectible for those 10 years, they can no longer assess him after 10 years after they assess the tax.
So my follow-up.
Obviously, if you're in between the first year 1 to year 10, and the IRS is coming after you aggressively, and there's nothing that would make you non-collectible. In other words, you're working and you have assets. They're going to come after you, and they could garnish your wages and your pension, et cetera, et cetera. But if you were non-collectible, in other words, you were poor as a church mouse, and 10 years lapse, what happens, Steve?
Then the debt's gone.
Amen.
It falls off,
It
or
goes
he has to
away.
hire an attorney or something to get that off his credit, because right now he has a tax lien or something.
Well, believe it or not, a tax lien, whether it's first of all, a tax lien will remain on your credit report for up to 10 years, and if it's an unpaid tax lien, it's even a bigger hit on your credit report. So regardless of the fact, he's going to have that tax lien on there for at least 10 years.
And that 10 years, the IRS can renew that tax lien. And they could be another 10 years.
Yeah.
So it all goes by what the IRS does with that tax levy after the 10 years.
So the whole thing is, if that person is unable to pay it, I suggest they do an offer and compromise. Would you guys agree?
Absolutely.
Get it
Because
totally
this way,
done.
these are the official forms you submit to the IRS, which basically says, "Look, I'm poor.
What about
I
yours?
can't pay it." They look at it and say, "By gosh, that person's poor and they can't pay it."
Yeah, and then what about
they
New York State, too?
And they might accept $500 in settlement of the debt. The debt goes away.
Should I have him call your guys' office?
Absolutely.
I mean, we would be very happy to help them, as opposed to some of the other firms that you hear on national TV. We charge like nothing to do this for people. So we just want to help people to get out of the problem with the IRS. We're at 632-7886, 632-7886, egtax.com, and we're there to help people. Okay?
Thanks, guys. Thank you.
You're welcome. All right, and then before we get to Dana and Heartland, and again, 8030930 is our phone number, 8030930, star 930 on a cell phone. We want to talk about injured spouse and innocent spouse.
Right. Well, just one other thing real fast. With it being in an uncollectible status, and you can do that for federal or state, they can at any time during those 10 years say, hey, please fill out a form again to make sure you're still uncollectible. It isn't just something that just, 1 year you qualify. You basically have to qualify every year, and you have to be prepared for the IRS to question you on that.
But that's what's so great about the offer and compromise.
It gets rid of everything.
Because if you really are in a very bad position and you're unable to pay the debt, you do the offer and compromise, and as long as you're good with the IRS for 5 years after they accept it, the debt goes away.
Yep.
Right?
Yes.
That's right.
Okay, let's talk to Dana in Heartland.
Hey,
Dana.
Hi, how are you?
Good. How can we help you?
Well, I've got a double situation, and you mentioned something I haven't heard of before, an installment sale.
Sure.
Well, I'd like you to tell me a little bit more about this. I moved to New York in 2011, and we were leaving Virginia, and we had 2 real estate investment properties there that we sold to someone, but we're still holding the note. They're paying us, and then we're paying the mortgage.
Okay.
We're trying to get a traditional mortgage, but the problem is that the restrictions have come down really hard on those who are trying to do investments.
Okay, so why don't you explain to Dana what an installment sale is? I think that's exactly what she's got.
Yeah, what you have is an installment sale. It says you owned a house. The person's buying it from you, and instead of going to a bank for a mortgage, you're the bank. So you say, okay, and for 10 years, 20 years, 30 years, the length of the mortgage, that you're going to pay me X amount of dollars, which includes principal plus interest at whatever rate, and that is an installment sale. So then on your taxes, you would pay tax on the interest you receive every year, or on the interest, yep. And then if with it being a rental property, you would have a 6252?
Yeah.
6252 to claim the principal part of the gain from that rental property. So there's 2 things you're going to have to potentially do on your tax return.
So Dana, you already have an installment sale, and I don't know if you've been doing your own return or you've had a tax professional, but it should be set up on an installment sale right now.
Okay, the way it's set up is that they are supposed to be making a balloon payment in 2013.
Are they paying you nothing right now?
Well, it's set up on an installment, on a, what is it called? My mind just went blank.
Like, are they paying you
On
monthly?
a land
or?
contract?
No, it's not a land contract. It's a situation that looks like a regular amortized
Amortization.
payment schedule.
Right.
But it's also set up that they will continue with that if they are unable to get their traditional mortgage in 2000.
Are they paying you monthly or paying the mortgage company monthly?
They're paying into an account monthly. That account pays directly to the mortgage company.
Okay. All right. So you already have an installment sale. So I don't know how you've handled it in the past, but it should be just exactly like Chris told you. It's an installment sale where a portion of the interest that you receive, if it's over and above the interest that you're paying, is taxable, and the depreciation you've claimed and the adjusted basis, a small amount's going to be taxable until the note is paid for. So if you want us to take a look at that to make sure it's been done correctly, we're happy to do that. Call us at 632-7886, and we're happy to help you with that, okay?
Okay, now I have one other question.
Sure, Dana.
I have a similar situation, only in doing this, moving to New York, we found the home that we wanted to buy, but because our debt-to-income ratio is too high considering the rental properties in Virginia, we bought this on a lease option. Now, is there something we can do differently? Should we also get this one from a lease option into a installment as well?
Okay, so that would be for the person that's holding the mortgage. Is he willing to hold the mortgage?
I'm not sure. I'm just wondering if that is, if we're having difficulty because of our properties in Virginia, if it would be better for us
the thing is,
getting an installment here.
The installment sale has to do with the person that is the seller holding the mortgage, who acts as the bank. Your lease option person would have to be willing to sell the house and hold the mortgage. So really, that would be a question for them.
Okay, great. Thank you very much.
You're very welcome. Okay, guys, and then let's give people some last-minute stuff that they can do for their pensions.
Yep, absolutely. And you also mentioned a minute ago innocent spouse and injured spouse, so make sure you get that straight too.
Oh yeah, okay. Last
And
week
the difference.
we had somebody that didn't know that they could file a joint return even though their spouse had a debt that the IRS was going after, like student loan or child support. What can they do?
Well, that's where you would file the injured spouse form, because it's a debt that wasn't part of what happened after you guys got married. So since it wasn't a joint liability, then it's just his or her liability, one or the other. You could file an injured spouse, get your portion of the refund, and their portion of the refund would go to pay the back debt.
So, Stevie, let's say somebody didn't file a joint return because they knew that their part of the refund was going to go to the IRS. What can they do?
They can actually amend those years back, goes far back as 3 years, add a Form 8379 to that, and get their prorated portion of their
do one for the
refund.
state, too?
You can't do one for the state, though.
You're right, you have
because
60
New York,
days.
yeah, New York has this wonderful law where, what is it, Chris, 60
30
days.
30 days? Yep, 30 days where you can't get it anymore after that.
almost
So
laughable.
they really don't want you to get it if you don't file it timely. So
the whole thing is, if you're somebody that has never filed jointly with your spouse because your spouse has an outstanding liability, such as child support, student loans, I don't know, what else? would
Back
people-
federal
what
tax
else?
debt.
yep, or state debt.
Tax debt, and you've been married filing separately, it is in your best interest to amend those returns and file jointly, but claiming the form injured spouse so that the IRS will only take the portion of the refund that goes to that spouse, but not take your portion of the refund. And the refund is much higher if you're filing a joint return. So you might be getting $4,000 or $5,000 over the last 5 years, but you have to file that 8379, right?
Yep, absolutely. As a matter of fact, that couple I think we talked to last week on the radio station made an appointment with me yesterday, so it was good news. It was really good news.
All right, so, and quickly, we only got a minute, what's an innocent spouse?
Innocent spouse is when you did file jointly with that person, and maybe they did something on the tax return that was really bad.
Sleazy, right?
Right. And you had no idea, you were unaware, or maybe you were forced into signing off that return. You could file an innocent spouse and be relieved from the debt.
Amen. Okay, this is Auntie Esther with Chris Sabian, Tiffany Sabian, and Steve Jacobson signing off from EG Tax. If you need help during the week, we are here to help you. 632-7886, or join us at our website at egtax.com. Until next Saturday, right after Thanksgiving. This is Esther Golia signing off. If you need any help, we'll be very happy to help you. Have a great Thanksgiving. Bye-bye.
You've been listening